Hello. Welcome to my channel, my dear friends. My name is Avilash and I'm a trader next door. In this video, I'll be analyzing the chart of gold USD. So if you're watching my videos for the first time, you can subscribe to my channel for regular market analysis. So let's get started. So as you can see on the screen, that gold inches higher as investors focus on Fed meeting. So gold prices edge higher on Tuesday with investors looking forward to the Federal Reserve policy meeting as expectations grew that the US central bank would slow its monetary policy tightening given the upheaval in the banking sector. Yes, all eyes are on FOMC right now, and things will take a drastic move after FOMC because things are not the same right now. So there's a banking crisis going on. So Fed's decision will be very critical. So before FOMC, please close down all your positions, US dollar positions, whether it's on gold, Euro USD, JP USD, or others, especially beginners. If you have the experience, then you can go for it. But if you're a beginner, new trader, avoid the market during this FOMC because market will show extreme volatility. So let's have a look at the chart of DXY first. So right now DXY is standing at 103.41. This is the current market price. DXY broke the support of 103.50. And as you can see that after breaking the support, DXY is showing some recovery. Okay, is this a proper recovery? No. There is a high chance that after going up for a bit, DXY will be going down again. Okay, before FOMC, I think that the trend of DXY will remain the same. There should not be any drastic move on the chart of DXY. And if we look at the chart of US government bonds, then we have a very significant pattern here. You can see that though we have a very bearish control on the chart of US bond, those sellers are dominating the chart of US bond, but we can also see a falling wedge pattern, and falling wedge pattern is a trend reversal pattern. If you just look at the present chart, okay, if I just remove the present drawings and all, then overall you can see that the market is very bearish. Sellers are dominating the market, but if we draw the lines here, then we can see a falling wedge pattern. Falling wedge pattern is a trend reversal pattern, and sometimes we get to know the direction of the market before the news. So yes, there is a possibility. Yes, there is a possibility that after FOMC, market may show, or bond may show a trend reversal and gold may go down. Okay, this is just a possibility that I'm sharing with you because we can see a falling wedge pattern on the chart of US government bond. Okay, but before FOMC, if somehow market breaks the pattern, then obviously whatever I have said right now, okay, my opinion will not be valid. Okay, so let's wait and watch. Time will speak. Okay, because in my experience, in my 9 to 10 years experience, I have seen that not all the time, okay, sometimes the charts speak before the news. Okay, so that's what I'm saying right now. So let's look at the chart of gold. So gold is standing at 1982, and right now I'm in a 15 minutes time frame. The reason is on the hourly time frame and 4 hours time frame, you'll not get a proper picture. Okay, so as a result, I'm using the 15 minutes time frame, and on the 15 minutes time frame, you can see that gold is standing at 1982 right now. Though all the things are pointing towards an upside, but right now gold is silent. It's just like the silence before the storm. So during the day, if gold comes down, then around 1969 we have a minor support. Around 1969 we have a minor support. If market takes support, if you see market taking support and going up, you can go for a buy position. Usually in this type of scenario, I do not recommend a buy position because market has already bounced twice. But this time we also have the moving average coming up. So along with the previous price rejection around the area, we also have moving average. So as a result, there is still a possibility that market will take support. So if market comes down, observe the volatility of the market. If you see that the volatility of the market is like this, means small candles, means you can expect that 1969 will act as the next support. If market takes support, go for a buy position. And if market shows extreme volatility, because probably you have observed in the last couple of days that market has become very unpredictable. Okay, um, Asian session market is different, European market session is different, and US session is completely different. So the market has become very unpredictable. So in case during the European session and US session market shows extreme volatility and market starts falling, then this may not work, and your next support will be around 1959. Okay, so the first support is 1969, then the second support is 1959, and the third support is 1946. 1969, 1959, and 1946, these three are the supports on the chart of gold for the day before FOMC. So observe the volatility of the market. When you see market taking support any of these levels, you can definitely click on the buy button. And if you're wondering about resistance, then before FOMC, right now 2010 is the resistance. But market has shown extreme volatility. My God, in one session, gold is showing move of 200 pips, 300 pips. So as of now, it seems that 2010 is the resistance. If market goes up and reverses, you can look for a sell position. But in case market betrays our expectation and market breaks the resistance, then obviously you need to follow the strategy that I have been discussing for the last couple of days. That is, follow the trend, buy at dip. So whenever you will see a trending market, buy at dip is the best strategy for an uptrend market. Sell at resistance is the best strategy in a downtrend market. If we switch to the 1 hour time frame or the hourly time frame, we can see that we may have a head and shoulder kind of a pattern. So but the shoulder is right now going like this going like this, so it can't be trusted. Okay, so again I'll say, so in this type of market, when there is extreme volatility, it's better to trade from level to level. Do not try to predict the market for hundreds and thousands of pips. Okay, try to trade from level to level. And if you're looking for safe trading opportunity, then it's better to open and close your positions within the same session. Means if you have opened a position in the European session, then okay, try to close your position during the European session only, because market is showing different phases in different sessions. Okay, I'm just recommending this for your own safety. Okay, till FOMC, be careful. Hopefully after FOMC we will get to see a new direction in the market. We will get to see a proper direction for the next couple of days and weeks. Till then, it's better to stick with the levels. Again, I'm repeating, 1969 is the first support. Okay, if market does not show extreme volatility, you can expect 1969 to act as the support. Because why 1969? Because previous price rejection around this area, but already market has tested it twice, so be careful. Okay, and the second support is around 1959. It more or less it is a good support because of previous price rejection around the area, and as well as Fibonacci. And thirdly, we have around 1946. These three are the supports for the day. If market takes support, then only bounce. Observe the volatility. Be a trader, not a gambler. Okay, and then we have 2010 as the resistance right now. But as the market has been showing extreme volatility, be careful. Taking a sell at around 2010 is like standing against the trend of the market, which can be dangerous. So if market remains like this, then only look for a sell position. If you see the market is going up, forming big green candles, the bond is falling. Okay, bond is falling, then do not expect. Okay, take your decision wisely. And for additional confirmation, look at the chart of US bond. If bond shows a big red candle, okay, after some time, then obviously you will see a big upside on the chart of gold. So trade carefully and please follow proper risk management. As I always say, do not gamble with your hard-earned money. Capital protection should be your first priority always. Right now market is volatile, unpredictable, so as a result try to go for a lesser lot size, small lot size, so that you do not lose your capital. When the market will be normal, okay, you should be having your capital with you to trade. Bye bye, take care.